Welcome back to another video. In this video, we are going to go over multiple time frame analysis. We will break down what is multiple time frame analysis, how does multiple time frame analysis help us, best time frames to use, and examples of multiple time frame analysis. Now, first and foremost, what is multiple time frame analysis? Multiple time frame analysis is simply the process of looking at different time frames for a stock to find the best possible trade entries and exits. Now, most people, when they trade, they're strictly focused on one time frame. They look at the 5-minute, they look at the 15-minute, they look at the daily, and they're so focused on just that one time frame. And most of the time, looking at just one time frame is not the best way to go. So the idea of multiple time frame analysis is to look at multiple different time frames for the same stock, so we are able to find a better entry point. We can find a better exit point, so we can see the full chart from different perspectives. So for example, if you look right here, you'll see the same stock. So in here, we're going to analyze the same stock in two different time frames. So this is stock ABC, and this is also stock ABC, right? Now, this is the daily chart right here, and this right here is the 15-minute chart. Looking at the daily chart, we get a bigger perspective of what is happening to the stock. We see where the critical levels are, right? We see where price is getting rejected. We see the direction, right? We see what's going on by looking at a bigger time frame. Now, when we look at a bigger time frame, the whole idea of multiple time frame analysis is now we go to a smaller time frame, such as a 15-minute time frame, to look for better entry and exit points. So for example, when we look at the daily chart, we see right here there's a trend line. We see that there's a trend line right here, right? So when we go and take the same trend line to a 15-minute chart, we can see the wicks right there showcasing buying pressure, the wick right there showcasing buying pressure, strong green candle showcasing buyers are stepping in, they're getting aggressive. So this allows us to now take an entry right here. It allows us to be very precise on getting in and out of certain trades by looking at multiple time frames of the same stock. So how does multiple time frame analysis help us? So multiple time frame analysis gives us a bird's eye view on the chart, so we can see the chart from different points. So we can see everything that we need to see for that one particular stock. So for example, right, if we look at a stock on, let's say, a daily time frame. On a daily time frame, you might see something like this. But now if I just zoom in to a 5-minute time frame, right, and I just zoom into that section, I'm not going to see an uptrend. What I'm actually going to see is I'm actually going to see a downtrend, so I might be more on the short side, or I might be against the stock because I'm like, oh no, it's on a downtrend. But when I take a step back and I look at multiple other time frames, I'm able to see that no, we're actually taking a break, or it's having a pullback. We're still on a large uptrend. It is still moving in an up direction, right? So we're able to see the chart from different perspectives when we use multiple time frame analysis. It also gives us better entry and exit points. It helps us confirm certain setups, and it helps us manage our trade, right? So if we're in a trade, it'll help us to identify where are we going to take profits, where are we going to take a loss, should we get in right now, should we get out. It's going to allow us to do all of these things by looking at different time frames. And at the end of the video, I will go through certain examples to showcase this to you guys. So for example, if you look right here, we have a 5-minute chart, right? Stock ABC. Now, on the 5-minute chart, when we look at it, what do we see? We see that we are on a nice uptrend. Stock makes a move up, consolidates, and then boom, continues. Nice volume kicks in, strong move up. Now, a bad trader would look at this and say, all right, let me jump in, let me buy. That's what a bad trader would do. trader that is not consistently profitable, is not looking at the big picture. That person is just entering this trade right off the bat. A smart trader is going to say, okay, cool, I like the 5-minute, but the 5-minute chart is too small. I need a bigger chart. I need to look at a bigger time frame. So let me actually take a step back and let me get a larger time frame, right? Let me get the hourly chart. Now, if I look at the hourly chart, I can now establish my critical points because now I went from a smaller time frame to a larger time frame. And once I do that, I start realizing that, wait, this stock is actually at a very critical level. It's at a resistance point. You can see support, 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 has a hard time, support, retest of that level, which is now resistance, and now it is going into that resistance point, which was once support level. But if we look at just the 5-minute chart, we can't or we won't see that. But if we look at a larger time period like the hourly chart, we're able to identify that this is going right into resistance, and this is actually not the best trade to take as of now, right? That's why looking at multiple time frames and looking at a higher time frame is always a good thing to do, or going down to a lower time frame. So that's something that's very important for you to keep in mind when you're trading. Do not trade off one time frame. Look at multiple time frames, establish your critical levels, and identify where buyers are, where sellers are, what is the direction. That's extremely important. It will give you a very, very high probability on successful trades. Now, how do we do multiple time frame analysis? We do something called a top-down approach. Same thing I went over in one of the previous lessons. We start from a larger time frame and we work our way down, right? So let's say we start from a weekly and a daily time frame. We work our way down to the 4-hour or the hourly time frame, and then we work our way down to an intraday. Now, if you notice something, we do a top-down approach. We start from a higher time frame to a lower time frame. We are not ever starting from a lower time frame like the 5-minute and then working our way up. No, it's the other way around. Make sure you start from a larger time frame to a smaller time frame. That's the idea of the top-down approach. Now, what are the steps of using the top-down approach? What is the step of using multi-time frame trading? So the first step is we start checking the larger time frames. We always start by a larger time frame. We use the top-down approach and start with the larger time frames. First, like the weekly and the daily time frames, and we check them for the following information. We check them to see and establish critical levels like support and resistance. So when we look at our large time frames, we are establishing our critical support level, right? We're also establishing our critical resistance level. We're identifying our supply and demand zones. We are establishing trend lines. Establish if there is a trend line to begin with, if it's on an uptrend, if it's on a downtrend, meaning what's the direction of the stock? Where is the stock headed? Right? Identify if any chart patterns are forming. Right? So looking at a daily time frame, you might see that a double top is potentially forming. You might see that an ascending triangle is potentially forming, right? Now, once you do that, you can also look to identify what chart phase the stock is in at the moment. So for example, stock may be on an uptrend and now it's maybe taking a break. It's consolidating on a daily time frame. So when we look at the big picture, when we look at the large time frame, we can see that we have been on an uptrend and now we are taking a break. We are consolidating. The stock is consolidating at this exact moment, which is obviously a good sign for the stock to continue. So looking at the larger time frame allows you to evaluate everything you need to evaluate of the stock. But that is obviously not enough. Once we look at the larger time frame and once we confirm the following, we then go to step 2, which is confirmation zone. The idea of confirmation zone, which is step 2, is that this is where you go to a smaller time frame, such as the 4-hour or the 1-hour, to confirm the setup you have established on the daily, if there was any. So for example, let's say we look at a daily time frame. On a daily time frame, we see that there's major resistance level at this point. Let's call this point $14. Now, when we go to a smaller time frame like that 1 hour time frame, the hourly time frame, we'll see a lot more price action at this $14 level than the daily chart. We'll be able to confirm, is this a strong resistance? We'll be able to confirm, is this actually getting rejected by going down to a lower time frame? Now, if it is a strong resistance and we want to make an entry and we want to see if it breaks resistance or not, and we're like, okay, if it can break 14, I might possibly get into the trade, right? Let's say that's 14, and you're like, hey, if it breaks 14, I might possibly get into the trade. That's where your step 3 comes in, which is called execution time. This is where you go to a smaller time frame, such as a 5-minute or a 15-minute, to execute and make a precise entry. So let's say on the daily time frame and on the hourly time frame, the stock breaks out of 14. You can now go to a smaller time frame, such as, let's say, a 15-minute, and use that time frame to confirm and actually execute the trade, because you'll see more candles, you'll see more price action around that time frame, and you'll be able to get a more precise entry opposed to taking the entry on a larger time frame. So once again, the whole idea is we work on a top-down approach, right? We use a larger time frame and we work our way down to a smaller time frame. Using 2 to 3 time frames is enough. You don't need to go through like 9 or 10 different time frames. 2 to 3 time frames itself is enough, and that's all you really need to focus on, and then work your way down, not up, and then analyze the stock for the best possible entry and exit points. Now, the question some people have is, all right, I got the idea of multi-time frame trading. Makes sense. Start from a large time frame, work your way down to a smaller time frame, but what time frame should I focus on? What is the best time frame? I don't even know what time frames to select. So now that comes down to one straightforward answer, right? It's different for everyone, but the straightforward answer that it comes down to is legitimately that it depends on your trading style. What is your trading style? What is your trading plan? How do you plan to approach the market? The way you trade, the way I trade, the way the person next to you trades, and so on, is all going to be different. We are all going to have a different trading style. We're all going to have a different approach. So depending on what your approach is, depending on what your trading style is, and in the upcoming lessons, I will break down on how to identify a trading style and how to have a solid trading plan and actually create one, so you're not actually lost with that. So I will break that down in the upcoming lessons. But to know what time frame you should focus on, you need to establish what your trading style is and how you are actually going to trade. Now let's go over certain time frames so you can kind of get a good idea of what different time frames and what different trading styles could be. Right? So for example, we have 3 time frames. We have a long term, we have a short term, and we have intraday. Let's work with long term. We're going to focus strictly on long term for now. So long term time frame is using, let's say, a weekly, a daily, 4 hour. This is where you're kind of like a swing trader, maybe a position trader. This is where you're holding trades from a few weeks to some months, right? Your trades are from a few weeks to sometimes a few months, right? When you're trading on longer term time frames, or that's the charts you're focused on, you don't have to watch markets intraday. You don't have to watch each minute move. You don't have to watch each 5-minute candle. You can look at larger time frames because you're looking at a larger move on the long term. So you don't have to watch each single tick, each single move up or down, right? And you also have more time to think through each trade. So for some people that, let's say, don't want to be in front of a computer or can't be in front of a computer all day, can't day trade, and they want to be swing traders and find good plays with catalysts and certain news, you'd be a long-term trader and you're focused more so on these time frames, right? Let's say you're a short-term trader, right? Short-term trader where you're holding a trade from few days, from few hours to few days, right? So sometimes your trade could be 5 hours, sometimes your trade could be 5 days, sometimes it could be 2-3 weeks, right? As a short-term trader, you're using the 4-hour, the hourly, the 30-minute. You're not going into like the minute or the 5-minute. You're kind of in the middle. This is your bread and butter. This is the main chart you're kind of focused on. And then the last one we have is intraday. This is where you're a day trader. This is where you're getting in and out of the trade the same day. You're in and out of the trade the same day, right? You're out by market close. The idea of day traders is people want to be in and out of trades the same day. They have no overnight risk, and the moves are a lot faster and quicker, right? Now, what you need to understand is as an intraday trader, you're looking at 1 minute, 5 minute, 15 minute, or 30 minute, right? Not all four, but you're going to like very small time frames. This is like the ultimate very high time frame. This is like a very large time frame, the 30-minute. But your bread and butter is a 1 in 5. That's like the two day traders are focused on the 1 minute, the 5 minute. They're focused on this, right? Now, even though these are the different time frames for different type of traders and focuses, we're still doing a top-down approach always. So even if, let's say, you're a day trader and you're using an intraday time frame and you're like, oh, well, I just got to use the 1 in 5 minute. Yeah, that's where your entries and exits are coming from. But you are still doing the top-down approach. You're still establishing your you're still looking at a long-term time frame, establishing your levels, and then working your way down, and then you are making your entries from here, right? Same thing with this. You are making your entries from here. Same thing here. You're making your entries from here, but you're still doing a top-down approach, right? Do not ever do it the other way around. Do not ever get into a trade and say, all right, I'm an intraday trader, so I'm only going to look at the 1, 5, 15, and the 30. I'm not going to look at the daily. No. Look at the larger time frame, work your way down. This is just to explain to you on what time frames you really need depending on what trader you are. Long-term trader, you're going to need longer-term time frames. That's what you're focused on. As a long-term trader, right, let's say you're a swing trader, you're focused on the long-term side, you don't really care about the 1 minute. The 1 minute is irrelevant to you. All that noise that's happening throughout the day on the chart doesn't matter to you. You care about the bigger picture, so you're looking at bigger time frames. So understanding that is very, very crucial to your trading, right? Now, a few key takeaways on multiple time frame analysis. Number one, our analysis should never, ever, 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 ever come from just one time frame. Do not go on, let's say, a daily time frame and say, okay, I'm going to buy the stock. Do not go on just a 5-minute time frame and say, oh, I'm going to short the stock. No. Make sure when you do your multiple time frame analysis, you are looking at multiple other time frames. Do not just use one time frame. Use more than one. Always check at least 2 or 3 time frames before taking on a trade. Example, if you are looking to buy a 15-minute breakout, make sure you check the 1 hour and or daily time frame for confirmation. So for example, on a 15-minute time frame, right, you might see that a stock is breaking out. It's breaking out of a critical level. But the moment you go to a daily time frame, you might see that this stock is not breaking out at a critical level. It's actually going on a downtrend, and it's retesting that resistance point, which is maybe around right there. And for you to see that resistance level, right, for you to actually see it from a daily time frame, you need to be able to go to a larger time frame and then go and work your way to a 15-minute. But if you're just on the 15-minute, this critical level would not pop in. So what most people would do, they'll end up buying this thinking that this is breaking out, but in reality, gets rejected and continues going down. That's why understanding and identifying those critical levels on a larger time frame is very important, and then working your way down is obviously more important. So once again, do not start from a smaller time frame to a larger one. Start from a larger one to a smaller time frame. Work your way down doing the top-down approach, and always use 2 to 3 time frames. You don't need to use more than 2 to 3. Don't go crazy using 5, 6, 7, 8. 2 to 3 is more than enough. Next, you should know your trading styles so you have the best selected time frames as needed. Knowing what type of trader you are, knowing how you want to approach the market is extremely important so you can select the time frames that you need. Right? A lot of people don't know what time frames or what type of trader they are. So for example, let's say you are a swing trader, right? You're a long-term trader, right? You're holding positions from 1 week to 4 weeks or whatever the case is. You don't care about the 1 minute time frame. Now, if you're looking at the 1 minute time frame, you're just creating noise for yourself. So that's why it's very important knowing what type of trader you are, what your approach to the market is. Like I said before, we do have a lesson in the upcoming videos that will break this down for you so you can actually create a plan, understand what type of trader you are and how you're going to approach the market. But once you do understand that, make sure you either come back to this video or you have everything established on what time frames you're going to focus on. And then finally, don't select time frames that are too close. You won't be able to tell the difference, which would be pretty useless. So for example, don't look at a 1 minute time frame and then have a 2 minute time frame and then have a 5 minute time frame and then have a 15 minute time frame and then have a 30 minute time frame and then have a 1 hour time frame. That's not doing multiple time frame analysis. This is you just wasting your time, right? Doing multiple time frame analysis could be something where you use the 1 minute, maybe the 5 minute, and then you skip to, let's say, the hourly, then you skip to maybe the daily, right? But doing something like this is not efficient, right? Just to recap everything before we move on, multiple time frame analysis is very, very, very important. Make sure whenever you look at a stock, you're always looking at multiple time frames. Now, next, I'm going to show you guys some examples of me going through some stocks and breaking them down so you guys can actually see live on how multiple time frame analysis actually works. All right, so if you guys take a look right here, we are looking at stock Microsoft. We are on a 3-year, 1-day chart. That means all of this information represents information for 3 years, and each candle represents information for 1 day. Right now, let me just navigate through the time frame. Let's say I go to a 3-year weekly time frame. You can see this represents information for 3 years, and each candle, which is right here, represents information for 1 week. Right? Now let's break some things down. Right? Now, if we look at a weekly time frame and we look at a daily time frame, 3-year, 1 day, it's the same exact thing. Same concept. The only thing is when we look at a weekly time frame, there's less noise. Look at how clean this is. There's less noise. You see stock goes in an uptrend, we get a bull flag, it takes a break, and then continues, right? We can see everything. It's less noise, but it's not detailed. To get more detailed, we need to go more and more down on time frames to get more precise entries, to get more precise price action. So if we're on a weekly time frame, daily, hourly, 5 minutes, right? We get more precise action, and we are able to see what's actually happening on a deeper level when we go on a smaller and smaller time frame. But when we are on a larger time frame like the weekly, everything looks very, very clean and straightforward. But remember, we're not going to look at this and say, all right, I'm going to buy, all right, I'm going to short. No, we're using this to do our analysis and then take the trade from there. So how are we doing our analysis? We're doing our analysis starting with the 3 steps of multi-time frame trading. So the first thing we always do is we start from a larger time frame. When we look at a larger time frame, this is what we establish. We establish critical levels of support and resistance, trend lines, if any, identify the direction, identify if any chart patterns are forming, and identify what chart phase the stock is in. So let's identify all of these 5 steps on breaking it down. First and foremost, Microsoft. Microsoft is on a healthy uptrend. right? Now, as it's on a healthy uptrend, let's establish our critical levels on that uptrend. We have our resistance point, which is the all-time high 142.37. That's automatically our resistance point. Remember, whenever stock hits an all-time high, that all-time high is automatically our resistance point. Besides that resistance point, let's find support, because we need to establish both support and resistance. We have resistance, we now need support. We need a support level. So when we go down here, look, all right, let's find our support, and we find something right here. Now, what direction is the stock in? Once again, we see that we were on an uptrend, stock took a break, it continued, and now it is taking a break. It is consolidating. It's in a consolidation chart phase, right? It's taking a break. Same thing here. You can see stock goes up, takes a break, continues, takes a break, continues, consolidating. Now let's work our way down to a daily time frame. Now, when we look at a daily time frame, same concept. We can see what is happening. We see stock had a nice uptrend, got rejected around 131, pulled back, rejected around 131 again, pulled back, right? Broke 131, consolidated, boom, retest, 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 and now it's having a hard time breaking 142, 143. Now, once that's identified, what direction are we in? We are trading sideways. That's number one. We are sideways from a bullish uptrend. So this could be the stock taking a break, right? So if the stock is taking a break, for this break to continue moving in a certain direction, it would have to break the all-time high. Next, do we see any chart formation, or do we understand anything about price action? Yes. We notice that if you guys take a look right here, you can notice that it is on a healthy short-term uptrend. Now, this is where understanding price action plays a huge role, because if you look at this, this is kind of the ascending triangle. Remember the ascending triangle, stock tries to break a critical point, gets rejected, buyer step in, goes up, gets rejected, pulls back, buyer step in, gets rejected, pulls back, buyer step in. Buyers keep constantly stepping in, showcasing their strength, which is obviously a good and great sign. That's the same thing that's happening here. It's not perfect, but it's the same concept. Stock goes up, gets rejected, pulls back. Goes up, gets rejected, pulls back. Goes up, gets rejected, pull back. Goes up, gets rejected, pull back. Now, if you notice that all the pullbacks, the lows, look what happens on all the lows. What do you see happening? All the lows are getting higher and higher. So looking at the chart price action, we can see that it's extremely, extremely strong. Now, when we have this established, we can work our way down to an intraday chart and confirm. So let's say I go to a 15-minute time frame, or let's say, let me get 30 days, 15 minutes. I can see that this trend line is working. Hits this level, goes up. Around that level, goes up. Around that level, goes up. Around that level, goes up, goes up, goes up. It's not perfect, but it's the idea behind it, right? So even if, let's say, I go to a, I don't know, 90-day, 30-minute, and I try to make it a little bit more perfect, right? Let's just say I want to make it somewhat more perfect, right? And I'm like, you know what? I want to see if this level is actually working, and I do try to fix it. Remember, it's not going to be an exact level or line. It's the idea. So if this stock, let's say tomorrow, is able to bounce, and I can see on the opening there's strong buying pressure, this could be a short-term trade, and I could possibly take on the trade from there and maybe look to take profits around 140, right? So that could be one trade idea. Depending on what my trading style is, like I said, I'm going to get into that. That's one way I could take on the trade. Another way I could take on the trade is I can say, you know what? I'm not comfortable in trading this. I don't like all of this price action in between. I would be more comfortable in buying this stock if it can break 142.37, if it can make a new all-time high. Why? Because if it can make a new all-time high, right, price action is already telling me that the buyers are stepping in, they're getting stronger and stronger. But if it can make that all-time high, I'm going to know that it was backed by a lot of aggressive buyers, right? So that's one other way that you can approach it. But the whole idea is to look at the chart and establish your critical levels, establish everything, work your way down to a smaller time frame so you can get better entry and exit points. Like for example, if you look right here on a 15-minute time frame, you can look, stock goes to the trend line, the wick showcasing buyers are stepping in, rejecting, breaks the opening price, does make a quick short-term day trade move up, right? Now, also another thing with looking at multiple time frames is if I take this trade tomorrow, right? Let's just say for argument's sake, tomorrow the stock opens up. As the stock opens up tomorrow, it opens up at like 138 and makes a move up. I'm not looking to swing trade this position right now. I'm not looking to hold this for a longer term time period. I'd be willing to hold this for a longer term time period if the stock can break 143, hold above it, and continue. That is giving me a strong move. That is showcasing that we are on an uptrend. And if we are on an uptrend, that's where me as a long-term trader looking to be a swing trader, hold this for a few weeks, I'm going to make money. But seeing that it's between this tight area and I trade this tomorrow, I'm going to be an intraday trader trading in between this small little zone. So keep that in mind, right? That's the idea of multi-time frame trading. Now let's go over two more examples actually. I'm going to break down two more examples and kind of take it from there. All right, so here's another example. Now here we're looking at stock Roku, 5-day, 5-minute chart. This is showcasing us information for 5 days. And each candle represents 5 minutes, okay? So now, when we look at this Roku chart, right off the bat, this is how most people go about it. They go about the chart. They go, all right, I have a support level here. This is the lowest point the stock's been at. All right, let me short this stock because it broke that point. Now, that is not the proper way to do analysis, right? Because you're just looking at a smaller time frame, right? Now, another thing people do is they look at a smaller time frame and then they work themselves up to, let's say, an hourly time frame, right? And they're like, oh, I'm at an hourly time frame. Let me confirm this level. Let me confirm that point, and they keep working their way up. That is the wrong approach. Now, if you're someone that shorted this stock because it broke this low on your 5-day chart, that is a bad trade, right? The smart way to go about this, right, is to look at a larger time frame. Let's say a 3 or 1 day time frame. When we look at a 3 or 1 day time frame, we realize that the stock is trading here. Since the stock is trading here, I only care about everything that has happened around this range. Now, in the past 3 years, the stock has only been around this range during this period. So I don't care about all of this. I don't care what the stock did at 15. I don't care what the stock did at 40 or 50 or 60. Maybe if it gets to 40 or 50 or 60, I'll then care. For now, I don't care. I just care about the current area the stock is trading between. So I can zoom in. I zoom in and I'm like, all right, let's establish my critical level. So I identify my demand zone. I identify that I actually have a solid demand zone right here. So around this point about 139, 140, I have a solid demand zone that this stock, let's take a look, a solid demand zone, which was once supply zone or resistance, that is now my demand zone, right? So let's just refresh that for a second. You can see resistance, gets rejected, supply zone, pulls back, has a hard time here, breaks out, pull back, and it's coming right into my demand zone, right? So right now, this is demand. If it breaks this demand zone, that demand zone now becomes supply zone known as resistance. So let's understand this chart before we jump into taking on a trade. Stock was on a healthy uptrend, gapped up because of earnings. They had good earnings, good guidance, everything looked good. Recently, there's been a lot of negative news that came out with this stock. I'll get into this trade breakdown in the upcoming lessons, but there's been negative catalysts, right? But for now, let's just focus on price action. So what happened? What happened is this day and this day, the stock had a huge sell-off. Look at the candles. The candles are showcasing bears are in complete control. Bears are in complete control. And there's a lot of volume these days, right? So if you look at the volume bar right here, This is the volume. And watch when I go on this day and look at the yellow highlighted area, the volume is 14.8 million, 23 million, 28 million. But now when we go to the huge red day, right, it goes a little bit to 23 million and then boom, 34 million. A huge spike in volume. You can also see that spike right here. Huge spike in volume. So stock is on an uptrend. It has 2 days of aggressive selling. And then what does it do right after? It takes a break. This is a very healthy break. This is what we want to see, right? Because if this stock went through this level, I wouldn't be as comfortable trading it, right? Because I know that that bounce up would be very hard, right? Right now, I already know that it made an aggressive move down from $176 all the way to about $140. It made a huge move down in about 2 days, right? So it made a $36 move down in 2 days, which is extreme for this stock, right? Now, what did it do after? It took a break, it kind of formulated a bear flag, and then today it gapped down and it's going right into my support area. So right away, I am interested in trading this stock. When I look at it from a larger term time frame, I'm super interested in taking on this trade because I see that it pushed down, took a break, and now it's pushing down again. I also know that there's a lot of negative catalyst here. What was the negative catalyst so you guys can start putting some pieces together? This is stock Roku. Roku is into the streaming business. So what basically happened in these days is their competitor Apple has announced a streaming service. Besides Apple announcing a streaming service, Roku has been getting a lot of downgrades saying that they're overvalued. So the sentiment for Roku has switched. So there's a lot of downward pressure for Roku during this moment, and price action showcased that it was very, very crucial. Now, if Roku is able to break this 138, 139, 140 area, we can now take on a certain solid high probability trade. Now, we can't trade it just off the daily time frame. This is where we work our way down. We work our way down for the confirmation zone. We confirm these levels. So I work my way down to, let's say, the hourly chart, the 4-hour chart. I can confirm these levels. I can confirm these levels. I can even go to an hourly chart, right? Even if I go to an hourly chart, or actually let's go to a 30-minute chart. Even if I go to a 30-minute chart and I check these levels, I can see it goes up, gets rejected. The supply zone, resistance area gets rejected, finally breaks out of that area, retest, right? And then you can see right here, past few days, same exact area. It fell, the stock fell. We're on a 30-minute chart, by the way. Once again, stock falls right into support, bounces, goes close to support again, boom, and now it's falling right into support. There is a big difference of this right here falling into support and this. This already made a very huge down move, so the stock needs to take a break. So think about you running. If you run, let's say, 50 miles, let's say you run 50 miles, right? Straight, you run 50 miles. What do you need to do? You need to take a break. If you keep running, you might be able to pump out 10 more miles, maybe 20 more miles. That move down is not going to be as strong. So stock makes a huge run down, takes a break, and now continues. So this move down into support is a lot better than this move down into support because it already made a majority move down. So at this point, I like how this is looking. So now for me to get an exact entry point, what I'm going to do is I'm going to go down to even a smaller time frame. So when I go to a 5-minute time frame and I look at this, I start realizing that around 137, right, a little bit outside of the demand zone, right, buyers are holding it up. So I'm going to keep watching this stock and see what happens if we keep looking at this in the upcoming few minutes. So let's fast forward and let's see what happens. So I just fast forwarded this just to kind of take a look on what's happening, and you guys can see Stock goes right down, takes a break, and you can see, boom, breaks out right there, breaks down right there, strong breakdown. So when we look at the daily time frame, we have this level established. When we go to an intraday time frame, like the 5-minute, what do we see? Let's understand price action a little bit more. We see that the stock goes into demand zone. Buyers are stepping in because they're holding the price up. Aggressive buyers are stepping in. The moment the price breaks out of that level where aggressive buyers are stepping in, the moment volume kicks in, you guys can see increased volume, strong move down. Bears are now in complete control, and now we have our entry. This is our entry to short, right? Going down on a smaller time frame, we're able to get a more precise entry with higher confirmation. We're able to short this trade or short this stock, and we're also able to put our stop maybe somewhere outside of that level. So we're risking about $3 into this trade, and even if you just look at the overall trade itself, you can see what's happening. What eventually happens, stock goes from about 137 all the way down to about 129. Stock makes an 8-point move down, right? It makes a very comfortable 8-point move down from 137 to 129, 130, right? Very strong move down. You can see it goes into support, takes a break, kind of the idea of a bear flag, breaks that, breaks the low of the day, boom, that's your entry. The stock already on the daily looks good too. So even if we traded this on the intraday chart, that's great, looks phenomenal. But when we go to a daily chart, that chart even looks much, much more better. What's so great about the daily chart? We can see resistance level, which is now support. Stock made a huge move down, takes a break, continuation. That even makes the trade so much more better for us having those things outlined. So that's why looking at multiple time frames when you're making entry points and exit points, it's extremely, extremely important. So now let's do one more. All right, so here I'm looking at Stock Shop. I'm looking at a 1-day, 1-minute time frame. What that means is this represents information for about 1 day, and each candle represents information for 1 minute. So let's break this down. Now looking at Stock Shop, right off the bat, what it tells me that this stock is on a downtrend. Right? So I'm looking at a 1-minute time frame, and yes, on a 1-minute time frame, Stock Shop is on a very, very healthy downtrend. That's great. But that is not the proper way to analyze a stock. A proper way to analyze a stock, as I mentioned before, is we should always start from a larger time frame. Now, when we start from a larger time frame, such as a 3 or 1 day time period, we start realizing that, okay, we need to establish our critical levels on this time frame. So where is the stock trading at? Stock is trading around 295s. This is the only thing I care about at the moment. I care about all the trading that has happened in between here. In the past 3 years, there has been no trading there. So all of this information for support and resistance is kind of irrelevant to me at the moment. So I can zoom in. Now, once I zoom in, I start establishing my levels of demand, my levels of support, resistance, whatever the case is. And I start realizing something. So from this point, there is a major, major demand area, right? I'm going to make it a little bit smaller. That's a bit too big. Just fix this. So you can see around this area, I have a major demand area, right? Which was resistance, breaks resistance, works as a nice support area, continues, and it falls right into that. So now let's analyze this chart first. We analyze that this has been on a very, very, very long uptrend, right? Was at $37 in 2016, and it's about $295. So it's made a huge run. Another thing we analyzed is that this stock was on a nice uptrend. That uptrend got broken. The stock is also recently reversing. It was at a high of 409, and it's at almost 296. So it went down about 25% plus in a matter of about a month, right? That's a huge drop, right? Now that huge drop happened very, very well. Dropped, consolidated, dropped, took a break, drop, took a break, drop. That's a healthy move down. So we understand that, right? Now looking at this, we had identified our demand aspect, and then we identify our resistance point. So we established all of these levels. So we have something around 316, 315. You can also apply this right there as well. So even if you want to, let's say, duplicate this and place this level around that zone, that also works, whatever you want to do. But these are the two levels I have established. Now, when I go back to my minute chart, right, or let's say I go back to my intraday time period, I can start realizing that this stock is looking like it's going to fall into the demand area. It hasn't fallen into it yet, but it's looking like it's going to fall into it, right? So what I'm going to do right now, I'm going to fast forward to a few days so you guys can see how the upcoming price movement actually looks. So this is the time frame we have until here, so I'm going to fast forward everything right now. Now when we fast forward, this is the day we were on before, and you can see what happens, right? You can see stock falls, breaks support level right here, 316, falls right into our demand zone, our support area, which is what we established, right? When it falls into that demand zone, let's see what happens with price action. Let's break it down. Let's go to an intraday time frame, 30-minute time frame. Stock breaks this major area, falls right into our next demand area, next support level. Stock rallies, and look where it rallies to. It rallies right to our resistance point and gets rejected, gets rejected, gets rejected, gets rejected. Now the reason that rejection is extremely important and identifying those zones are very important is because what happens with a lot of people is when they see something like this, they're too blindsided because they're looking at one small area instead of looking at the full battlefield. What that means is they're so focused on looking at this and they're like, oh, it's going on an uptrend. It's going on an uptrend. I should buy, I should buy, I should buy. Let me buy, let me buy, let me buy. And they don't understand that this is going right into resistance. Yes, there's a lot of small trading opportunities here for intraday traders. That's great. But you as an intraday trader who's looking to trade this for 10 minutes, 15 minutes, 20 minutes, whatever the case is, you should still know where profit taking should be, what your profit target should be. And the only way you can know that this 316, 315 area even exists is by going to a larger time frame. So if I didn't go to a larger time frame, I wouldn't know where to take profits. I wouldn't know where my resistance level is. But when I do look at a daily time frame, very simple and straightforward. Support, support, resistance, 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 support. You guys can see support and now resistance. So looking at this and doing this simple analysis and looking at multiple time frames, I now know that yes, the stock fell right into this zone. If it can now break this zone, I will possibly take on a short position. If it can break this area, I will possibly take on a buying opportunity. Obviously, it's not that simple. There's other things that go behind it, but based on what we've learned so far, that's the only thing I want you to focus on. There's other things to look at, such as how's the market doing? Why did this fall? Was there a negative reason? Yes, there was a negative catalyst. That's why it fell. Okay, for this to go back up, there needs to be a good catalyst, a bullish catalyst. Maybe the market, this fell, maybe the market was tanking. Market is probably going back up, right? So there's other factors that play a role too, and those factors need to be used in combination with price action. So just because this breaks it, we're not going to buy it. There's other factors that we need to look into. But for now, since we haven't covered that yet, we're just going to focus on that. Right, so once again, based off simple price action, looking at multiple time frame analysis, just to recap, we've established our levels, we identify the direction the stock is in, we understand that the stock is trying to take a break. If it continues this breakdown, we might possibly short. If it can break 316, 320, whatever the level is, we will then look to be buyers. And even when we work our way down to an intraday time frame, you can see multiple times, 30 minutes, 1 hour, whatever the case is, buyers, 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 resistance, 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 over and over and over again. If you go to a smaller time frame, you can see over and over. Today, What happened today is it did break that resistance level and got rejected right at 320, right at the top of the zone, and then kind of dumped. Tomorrow, if it can break 320, there's good news. Market looks strong. Very good possibility of this being a buying opportunity. But once again, other factors go into this. Just to recap everything, just so everyone is on the same page, whenever you're trading, make sure you use more than one time frame. Do not use or be stuck on using just one time frame. Use multiple time frames, right? So just to recap everything, when you're trading, make sure you do not focus on just one time frame. Make sure you use multiple time frames over and over again. 2 to 3 time frames. You don't need to use 5, 10, 20 time frames. 2 to 3 time frames is good. Always work your way from a top-down approach. Start from the top, work your way down. Start from a daily or a weekly time frame and work your way down to a smaller time frame. The whole idea of using multiple time frame analysis is to get the best entry points, to confirm your chart, confirm the structure, identify direction, and just to have the highest probability of trading on your side. So make sure when you're trading that you use more than one time frame.